Golden Rule Radio is brought to you by McIlvaney ICA. ICA has been helping people take delivery of precious metals and find storage options for decades. They have also helped thousands of investors with their precious metals IRAs. Call ICA today for your free portfolio review at 800-525-9556 or download your free report online by clicking the link in the video description to learn how you can double your gold and silver ounces even within your IRA.
Welcome back to Golden Rule Radio. This week we're taking a look at gold after a very nice climb through the beginning of July. Going back a few months ago to the correction level of 1680, we've seen gold take a high climb up to around 1900, decline down to around 1760, and then last week we talked a little bit about this turnaround we were expecting to the downside after we hit around 1835, which was a zone built by a previous market floor, and now we're seeing gold flirting with pushing below 1800. We do have a 50% Fibonacci correction line that is providing us a floor at least for the last few days, so we will certainly have to see if gold is able to push any lower than that. Now, the only number that really matters in the short term on the downside is below 1750. So obviously anything down we can go that stays above that still keeps gold very bullish, not just in the very long term like we've been talking about for years, but even in the short term as we're waiting for gold to make a healthy push up into the mid to high 1900s and resume the very clear bull market that we have been on. So these corrective phases do tend to last a number of months. We're about 6 months into this one on gold with very little turnaround from down in the 1200 range when gold initially hit bottom up to 2100, so almost doubling in price for a couple years. It's not surprising to see it come back a couple $100 before taking the next step forward. So as we continue to watch gold try to regain its strength in this long-term bull market that's caused by some of the inflation things, that I would definitely go back and listen to this week's episode of the McIlvaney Weekly Commentary where they dug pretty heavily into the inflation topic. But since we are looking at some sideways trading in gold, I do think it's important to bring up the ratios again this week, both the platinum and palladium ratio, which is still making ground, and the gold-silver ratio and what we've seen happen over the last year after COVID initially hit in March last year, causing that ratio to go way out of whack, and what we've seen since then and the opportunities that some of our clients may be looking at taking advantage of. So, Tori, from a ratio perspective, regardless of what the dollar's doing, regardless of what the dollar price of the metals are doing, what are we seeing the gold silver do, and where do you think the benefit is today?
Well, I think the benefit is more on the side of silver. We've been pushing it for a while. We did come into about a 40-year average position in the gold-silver ratio. We saw it actually dip below that. We got all the way to 62 at the start of this year, start of 2021. And we've now climbed to about 72.5. We saw the peak yesterday. We're down just a bit today, back down to about 71.5. And that's resulted because gold has come down a little bit. Silver has bounced off of its support level and popped up a little bit and narrowed that gap. So to me, there's still value in silver. We're taking equal positions. But when you see a nominal value decrease in the spot price and an increase in the ratio of gold to silver, both of those speak to the opportunity to be adding to your ounces of silver. So I'd love to throw up the chart from last week that you put showing that climbing wedge, if you will, and
Sure.
How you just clearly and beautifully bounced off of that support level yesterday and Monday as we saw metals come down. Remember now, everybody's asking the question, why is silver coming down if there's inflation? Why did gold not rally if there's inflation? Why did gold not go up if the stock market turned down? So I want to get a little bit into that as we play out the rest of this show. But why don't you show the silver chart and explain exactly what we're talking about there technically?
Sure, we did have an almost perfect bounce off of my sort of, let's call it fibbed rising wedge. I took a couple lows. There is a low in the middle you can see on the chart that dipped below it, but sometimes you have these panic moves down. So we did hit it here earlier this week. We have pushed slightly below it and slightly above it. Those types of trading ranges generally don't hold to the penny, but they give you sort of a range where you're likely to see some type of turnaround. Now, since it's a rising wedge, there's actually quite a few prices below it that still keep silver in an incredibly bullish position. While gold has been in this declining price range for the last number of months, one thing we've pointed out a few times is the fact that silver really never turned bearish. Silver, even though it's sort of stalled in this $5 range, it's a very big $5 range. And like you mentioned, the wedge or the compression, each high is a little higher, each low is a little higher. I did say that correctly, and that's what causes the wedge to form, where you're going to eventually see silver making very tight moves up and down, and then it'll have a breakout one direction or the other, and that breakout is usually fairly substantial. You don't just see it move up 50 cents or a dollar, but it may jump 6 or 8 or 10 bucks over a few months and then start the process again. So this is that stair-step concept I talk a lot about, where you take like 2 steps forward, you take 1 step back, and then you take 2 more steps forward. Silver really didn't take much of a step backwards, but it just sort of paused, and now we're waiting for it to take another step.
I'd say that gold paused as well. Maybe it's down 1% from the high a few weeks ago in this cycle.
Sure.
Silver's down 5.5%. That sounds terrible, but it's really not. We're used to far more volatility than that. But that 1% versus 5.5% decline is exactly why the ratio went from 68 to 72.5.
Right.
So the listener understands. Platinum, you're going to get into that as well. Platinum, palladium, both came down as well, but platinum came down 7% here in the last 2 weeks. Palladium, 11% from its high. So that's why the platinum to palladium ratio has improved. So why don't you jump into that and show those charts as well, and we can circle back.
Sure. Well, starting with that gold-silver ratio, I think it's important to look at the gold-silver ratio not on a 10-month or a 10-year, but maybe a 40 or 50-year timeline, because a lot of times we'll get asked, what's the number? And the thing is the number is clearly, if you look at these 40 years charts, a moving target. In 1970, the number would be 30. 10, 15 years later, the number's 35, 38. And it looks like if you follow this pattern, our next target number would be maybe somewhere in the mid-40s to low 50s. So we are seeing that increase, and you're seeing it increase on the top side, because what did we hit
That's
last
right.
year? The highest,
125.
the highest ratio in history, all of recorded history, high gold-silver ratio. So was the one prior to that when it hit 100, and the one prior to that when it hit somewhere in the 90s, 20 years ago. So we're seeing a pattern where gold is actually over time becoming more valuable than silver, because that ratio is increasing slowly. But like you said, you go back to the 1970s, what's your average? Probably somewhere in the 45 to 50 range. And now today, that average over the last 40 years is around 62. So it is important to work with somebody who is tracking these things on a long term, or a company like ours who's been around 50 years. So we have a lot of data, not just on the spot price, but also bars versus coins, coins versus coins, gold bars versus silver coins. There's a lot of different ways to track this to make sure you're not just taking advantage of that spot price movement, but also premium in different products as well. So we do have clients out there that even though we're at an average price in the gold silver ratio, it may make sense to take a portion of their silver off the table, depending on what size of a position it was and when they picked it up, say March or April of last year. So, and we are going through some of our clients and looking for those opportunities to just kind of balance things out a little bit. So that's something important to keep in mind. Platinum and palladium has had a pretty massive swing since the high in the ratio when platinum was at near all-time highs. Palladium was still $500-600 down in 2009. Obviously, that is flip-flopped. So there are a couple spots on this ratio where if you're looking at getting into platinum, like we've been recommending for the last couple years around 2019, 2020, you don't even have to have that much of a return to double the number of ounces. You don't even have to have that much of a return to triple and quadruple the number of the ounces just to get back to some median prices and price levels between the two. So that still remains an extraordinary opportunity in everybody's metal position. If you don't have a 10 or 15 or 20% of your metals allocated to platinum, I hope there's a very good reason you chose not to do that and it was an active choice. Otherwise, you need to make sure you're working with one of the advisors here at McIlvaney ICA and make sure you get a position into platinum as soon as possible.
So I want to come back around to gold because I'm getting a lot of calls from clients like, what happened Monday, for example? The equities at one point, the Dow Jones Industrial Average, for example, was down almost 950 points in one day. Well, gold was pretty much unchanged. Silver, like we talked about, had dropped about 2.5%. Platinum was down about 3%. And that's to be expected. So in the micro cycle, you're going to see the white metals act industrially. From an investment standpoint, you're going to see silver come down, platinum come down, palladium come down. Gold's going to act like the money metal in that type of a short-term cycle. In a long-term inflationary macro cycle, you're going to see the white metals be very stable and strong, just like they have over the last 15 months. So keep your eye on the longer big picture and use those short-term opportunities, those dips, if you will, for a chance to add into it. But you have to remember that gold reacts. Gold doesn't set its own market. Gold has done very, very well despite a few things that would make you think otherwise. Highest stock market ever. Very, very bullish economic and equities market sentiment. The dollar index being higher. So all of those things really point towards the fact that you would think that gold would be weaker than it is. But what do you have countering that? You have inflation.
Reality.
Yeah, the reality is a good point. You've got the equities drops and rallies, so the volatility or the apparent top in the equities markets. You have bond market volatility. I mean, we saw the largest one-day drop in the 10-year yield since March of last year, 2020, when COVID hit. So the bond market volatility, this talk now of economic downturn, COVID cases rising, all of those things are reasons why you would think that gold would start to rally. So it's really in the middle of this fascinating tug of war to me right now. And we don't know. So I would ask you, I would ask the listener, which fundamentals win out? Which ones win in the short term? Which ones win in the intermediate? But ultimately, which ones are going to win in the long term? And how are you investing accordingly? Because I don't know that I can answer that. We can point out the fundamentals, but we can't predict the timing of each of these news events.
You know, I think the key there that you said a second ago was the microcycle concept, because all a macro cycle is, all a long-term cycle is just the average of the microcycles. So let me address the question a little bit differently. Let me ask you a question. Why didn't gas prices go up in 2020? Why did they not start going up till the end of 2020, beginning of 2021? Because gold was going up in March, April, May, June last year.
Yep, silver was going up.
Right. But my point is, microcycles tend to be driven by emotional reaction, and a large trend is just the culmination of all those little short-term emotional reactions that tend to average a certain direction. So we had a massive move up in precious metals at one point of last year. We had a massive move up in the price of lumber at some point over the last 12, 18 months. We've had a massive move up in the cost of oil and gas up until OPEC has finally, just in the past few days, agreed to release additional oil reserves to push the price down. Same with lumber. Lumber had a massive spike and then a big fall. Gold had a massive spike and then an almost nothing of a fall. Real estate prices, I mean, for Pete's sake, how many phone calls and letters have I gotten people saying, hey, do you want to sell your house? Not really. Why are we seeing all of these things happen in the commodity market as a whole? And I think that's the answer to your question about what is the actual long-term approach to the dollar and the long-term expectation of the dollar. And then in the short term, you're seeing little microcycle spikes in a handful of adjacent commodity industries. So why didn't gold and oil and lumber and real estate all have the exact same price movement on the exact same day? Because that wasn't the thing getting the attention on that day. You had something get popular for a few months, then you had something else get popular for a few months, but it's all pushing the same direction when you average it all together. And I think that's the answer to your question. I think that's why you don't see on any given day, well, the Dow Jones fell 1%, why didn't gold go up 1%? Well, the money coming out of the Dow Jones to cause it to fall 1% went somewhere, and I bet you anything it went somewhere gold adjacent. And eventually that interest is going to shift back into another microcycle in gold, which let's say takes gold from 1800 up to 2800. And then you'll have the attention shifted elsewhere, and gold will fall from 28 to 25, and we'll be having the exact same conversation $1,000 higher.
You know, I think one thing to add to that as well is gold and silver react far more sensitively and immediately to monetary policy. So it's
Very
almost
true.
as if they are a little more predictive, or in the short term far more reactive. And then base commodities lag, and the data's there to support this. Base commodities tend to lag the precious metals in response to inflationary measures, by 4 to 6 months. So that's another thing that you have in play. So the next time you see that type of a spike in the precious metals, just know they're going to lead the charge, and they're going to act more like money metals than industrial metals. They're going to act more like money metals than commodities in general. They will lead the commodity cycle. So keep that in mind next time. And you talk about the money moving from equities to somewhere else. Well, I'll tell you what, I mean, JP Morgan just pointed out that we have an all-time high in the number of U.S. households owning stocks. David and Kevin do an amazing job in the weekly commentary last week of talking about this melt-up phenomenon, the number of dollars, the overvalued nature of the equities markets right now. Monday showed it. Monday's got this huge, almost 1,000-point decline. All of it's erased the next day. Literally, the S&P 500 bounced right off of its 50-day moving average. And you're talking about that being so significant. But we're on pace in 2021 to have more money move into equities than in the previous 20 years combined. That's how much money's moving into the stocks. And at the same time, you've got the Dow Jones transports that were predicting that Monday decline. If you're paying attention, there's a lot of things like the bond market, like the transports, that are telling you that we're due for an economic downturn. They're predicting a downturn. So they can juice the stock market and try to keep that gaming going. But even trucking stocks are down. So the transports in general are telling us a story. And David again talks too last week about stagflation compared to inflation or deflation or disinflation. And that stagflation is becoming more and more of a reality, where you have inflation, but the economy is slow. Growth is slow. And that's a dangerous combination. And now they're talking about this major infrastructure spending plan. There's going to be a vote on this. The Federal Reserve continues to buy $120 billion a month in like mortgage-backed securities and government bonds. They meet next week, so we'll see if that's going to continue. We'll have Fed minutes next week. But all of this, ultimately, with the debt, with the inflation issues, it creates a negative real rate of return. And that goes to the biggest of the macro cycles, talking about the dollar, talking about interest rates. As long as you get a real negative rate of return on your dollar. So take, for example, current 90-day Treasury bond, or that T-bill. That 90-day T-bill right now might get you about 5%, minus 13% for the real inflation rate. That's a negative 8% real rate of return. That's so bullish for gold that we can't scream loudly enough. The problem with that is that it's the government stealing. It's stealing from bond investors, because the Aiden sisters pointed out a negative 3% real interest rate actually reduces the real value of government debt by 46% over 20 years. So what does 5%? It reduces it 64% over 20 years. So it's them devaluing for the sake of defaulting. So technically they're defaulting. It's a soft default. And they're doing it through inflation. And they're going to continue to add to the debt because they have to do that in order to afford that over the course of the 20 years. So over the macro cycle, as long as they're doing that to the dollar, as long as they're doing that to interest rates, the negative real rate of return, you buy gold, you buy gold, you buy gold. And in a short-term micro cycle, you buy silver and platinum, so you end up with more gold.
That's going to do it this week for Golden Rule Radio. We appreciate you stopping by. If you liked what you heard, hit the subscribe button, ring the bell, head on over to our website, McIlvaney.com. You can find us on Twitter at ICA Gold or Facebook at McIlvaney Financial. And as always, if you'd like to talk about positioning yourself during this current microcycle in the precious metals market, we encourage you to give us a call at 1-800-525-9556. Thanks for listening. Have a great week.